Hello and welcome back to the 22nd episode of The Market Lens. I'm Sam Rozzi, manager of Due Diligence, and again I'm joined by Cliff Walsh, AP's Chief Investment Officer. Please check out our previous episodes available on YouTube or the Studio 454 video library. Hope all of our advisors enjoyed the national conference at Mohegan Sun. We sure did, and it was great to finally get out there and see everyone in person. Feels like it's been a bit since we've been here filming on the Lens, so let's just jump right into the markets and discuss the consumer. The state of the consumer has been in constant debate for most of the past 3 years, whether it's strong balance sheets, excess savings, the dry powder. All these terms have been thrown around. The household sector took on about $38 billion in non-mortgage credit in April. Cliff, do you think this is news or noise?
I think it's news. Inflation is spurring consumers to borrow more to meet current obligations. I think that's a sign that balance sheets are not that strong. I think the dry powder's gone, excess savings are gone. We've seen people make different decisions at the pump. They're buying fewer gallons per purchase. We warned of this a few months ago in our quarterly outlook. We said that the economy could be boosted by credit expansion in the short term, but it would be short-lived. If you look at the last 3 months, we've seen similar credit expansion to the April numbers, $120 billion. That's 11% annualized growth, which is a big number. Credit card debt is up even more, 22% annualized in the last 3 months. This is not sustainable. The economy contracted in Q1, and the Atlanta Fed GDP Now forecast continues to slip. It sits at about 0.5% growth for Q2. The risk is to the downside. This economic expansion could be over. Right now, the consumer is struggling to keep it going. Consumer debt to income, the ratio is higher now than all but one cycle peak dating back 60 years. And I think higher interest rates are going to weigh more and more on consumers. We've seen home sales and prices sagging, not to mention Ukraine, Russia, and food and fuel prices start to or continue to impact the consumer. So summing things up, the narrative right now is nonsense that the consumer is strong. They're struggling with inflation. Unemployment is about to start to tick up in my view. Consumer sentiment is at its weakest point in a decade, if not much longer. So the cheerleaders are nervous. The numbers don't support their hope from what we see.
Interesting, and I tend to agree. Borrowing to pay for living expenses never really seems to turn out well. So the credit card number data as well as the gasoline inflation really jumps off the page. I mean, paying nearly double to what you were paying at the pump last year is very difficult for the consumer. So let's switch gears over to unemployment. Comparable, but I think there's some unique things that we can zoom in on. So do you think unemployment will go up from here?
I think they all work together, but I think surely a bunch of this negativity is factored in from an equity market perspective and even from a fixed income perspective in terms of what we should expect from the Fed in terms of rate hikes. But I wouldn't get too complacent just yet from the recent rally that we saw off the bottom a week or so ago. Markets already rolled over again. The Fed is going to raise at least another 100 basis points in the next 2 meetings, could be as high as 150 basis points over the next 3. Some are speculating for a 75 basis point hike in the short term. I think that probably is aggressive, but still a lot more to go from a hiking perspective. Liquidity is coming out of the financial markets. The Fed's reducing the size of its balance sheet. That process has really just started, even though we've been talking about it for a while. Credit has been a tailwind for a while. It's starting to become a headwind. And I think that consumer can't borrow forever to fuel purchases. And I think unemployment, like I mentioned, is going to tip the other way, and that's going to continue to hurt the economy. So we haven't seen the bottom in equity prices just yet. In my view, we think any rally should be an opportunity to rejigger the portfolio and potentially de-risk.
Yep. Thank you, Cliff. Very interesting times out there from an equity and fixed income perspective. So I appreciate you tuning into this to learn a little bit more about the markets. And we hope this is letting you see 2020. Take care.